Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss step 1 of the Fundamental Retirement Plan, investment allocation. Specifically, we're going to discuss an introduction to the 5 steps in the Fundamental Retirement Plan, why the crucial first step is investment allocation, understanding if you're being properly compensated for the risk you're taking, how lack of diversification means you're leaving a lot of quality businesses on the table, key metrics we review as we diagnose your existing portfolio, how decisions you make in your investment allocation cascade into all other areas of your retirement plan, and lastly, as always, a few action items for you to consider. From my experience, the majority of people that go into retirement simply have a bunch of investment accounts. They don't know where they're going to get their income from or how much income they should take. And even though every family is different, we all have the same basic questions. Can I retire? How long will my money last? And if something happens to me, will my family be okay? Retirement is the time for you to fulfill your vision, your dreams, and find your next purpose in life. And in order to do that, you need a plan that allows you to feel comfortable with where you're getting your income from, how to pay less tax, and how we're going to make sure that your money lasts as long as you do. Now, it's never a good idea to put off planning for retirement. Whatever you want to do in retirement, the sooner we can start doing that, the better you're going to be. In retirement, every single decision that we make is like a domino that impacts everything else. So it's our job to put that puzzle together. We have to start with the outsides. We start with the corners and we start to fill in the middle. But we must first understand your purpose in the next chapter of life. We really get to know our clients and what their needs are. Finance is extremely personal, and we can't begin to understand somebody's financial needs without knowing them as a person, as a couple, or as a family first. Every financial plan is unique. Every tax plan is unique. There are no two plans that are alike. So finding your purpose in retirement is one of the keys to a successful transition from a psychological standpoint, but also maintaining your happiness. When you enter this stage, you need much more than just investment management. So it's our responsibility and our purpose to help as many families as possible with their retirement plan in order to do our part in helping people transition from the working years to the retirement years, and to do so in a comfortable and confident way. To help achieve retirement clarity for our clients, we've developed the Fundamental Retirement Plan, an intentional process that puts you in the center. Now, over the next few podcast episodes, I'm going to get into the detail about each one of the rungs in this ladder that we climb as we build your fundamental retirement plan. This is a customized process that coordinates decisions across the 5 key areas of goals-based retirement planning. First is investment allocation, what we will be discussing today. Now, the wrong ingredients in your portfolio could be the difference between retiring successfully or running out of money. The second step is income planning. With your investment allocation in order, we can create a dynamic retirement income that can be adjusted up or down based on your trajectory. The third step is tax planning. Now that we've allocated your investments and created an income plan, we can fine-tune our tax analysis to help minimize the amount of tax you pay. The fourth step is healthcare planning. Health is wealth. We need to factor in potential healthcare and long-term care costs, as a mistake here can be devastating. And lastly is estate planning. We want to be certain your estate goes to who you want it to, and less goes to CRA. All of these areas are interconnected, so the decisions we make from an investment standpoint will cascade to our income plan, our tax plan, and so forth. So today, let's do a deep dive into the critical first step of the FRP process: investment allocation. As I mentioned a few moments ago, investment allocation is all about having the right ingredients, the right mix to ensure you can have a successful retirement. Once we optimize the right investment allocation, it will then dictate how much income you will take. It impacts how much tax you'll pay. It may also impact your healthcare or long-term care strategy, and it will definitely impact your overall estate plan. In English, the decision you make with your investment allocation echoes across all other aspects of your retirement plan. So, what do we analyze when we go through this first step? Well, first off, we want to be sure you're being properly compensated for the amount of risk you are taking in your retirement portfolio. To best illustrate this, let's discuss a few examples. Let's say you have two investment choices, investment A and investment B. Both of them returned 10% over the previous year. Which one would you rather be invested in? Your first thought might be, Michael, it doesn't matter. They both returned 10. Just give me A or B. But when it comes to retirement planning, it's not about the return necessarily. Rather, how much risk did you take to get there? In advisor speak, we call this risk-adjusted rate of return, also known as a Sharpe ratio. In other words, what are the ups and downs you need to experience to achieve that rate of return? So even though the end result is the same, the experience you had as an investor to get there can be wildly different. And for a retirement investor who is looking to turn the tap on their investments to start drawing an income, we aren't interested anymore in big swings in a portfolio. So when we construct retirement portfolios, we are just as interested in the journey to achieve that rate of return as much as we are in the destination. To achieve this, we analyze your portfolio's risk-adjusted performance score. We do this by reviewing the metrics of your existing portfolio, such as its Sharpe ratio, max drawdown, standard deviation, annualized return, and cost. From there, we can assess if you're being properly compensated for the level of risk in your retirement assets. In its simplest form, think of it like we're measuring the risk-adjusted quality of your portfolio and assigning your portfolio a grade point average. The next investment allocation piece we review is diversification, which is the only free lunch in investing. We continually come across retirement portfolios that fall apart after a little bit of scrutiny. Two of the most common red flags we come across. First is an overexposure to Canadian markets. Time and time again, we come across portfolios with 40, 50, or even 60% of their investable assets in the Canadian market. Which, when you zoom out and add up the world equity market capitalization, Canada only represents approximately 3 to 4% of all public markets. To put this into context, the company Apple has a total market capitalization that makes up approximately 4% of world equity markets. So Apple, the publicly traded company, has about the same market capitalization as the entirety of the Canadian market. So if Canada only represents a fraction of all the publicly traded assets, why does it have such a dominant role in your retirement accounts? Now, some of you may argue, well, the big banks and large oil and gas companies pay such a great dividend. But I would argue you are sacrificing long-term capital appreciation by thinking too narrowly. The second red flag we come across builds on the last. It's not necessarily geographic specific, rather just a lack of diversification in their underlying holdings in general. So first, let's put this into a bit more context. As of December 1st, 2023, there were 525 publicly listed companies in Canada, 3,481 companies in the United States, and an additional 5,993 in international markets. Adding these up, you have approximately 10,000 publicly traded companies in developed markets. When you add emerging markets to this calculation, the figure doubles to over 20,000 publicly traded stock. Now have a look at your portfolio. Likely you have 40, 50, or maybe 60 or so stock positions and the odd mutual fund or ETF sprinkled in. If we add up all your holdings, maybe you own 200 of these public companies. If we put that into context when compared to Canadian, US, and developed international markets that totaled 10,000 publicly traded companies, this means your overall exposure to public companies in developed markets is only 2% of the overall universe. When we put together portfolios, we want deep exposure to all assets as we believe that markets are efficient and that hyperconcentration will result in poor outcomes over the long run. Our goal here is to diversify intelligently without sacrificing return. This is why we aim for a retirement portfolio solution that is holding around 10,000 positions across world markets to ensure our clients get broad exposure. We don't like to make big bets with your retirement nest egg. After we've analyzed the risk and return characteristics of your portfolio, along with a deep dive on diversification, there are a number of other financial audits we perform to ensure your best interests are aligned with how your portfolio is structured. I'll go through a number of these in point form to give you a deeper understanding of the lengths we take during the first step of the fundamental retirement plan. First is a review of your underlying cost of investing, which includes a review and understanding of the management expense ratio and trade expense ratio you are paying. Next is shining a flashlight on in-house proprietary funds that are lurking in your portfolio. These are the holdings that could pose a conflict of interest and generally align with the best interests of the bank or large mutual fund company you're currently working with, and not yours. Next, we want to review the cash drag across your investment accounts and within specific portfolios. I won't go into too much detail as this was really covered in episode 59 where I do a deep dive on cash drag. Lastly, we want to ensure there is a logical method behind the portfolio itself, which includes asking questions like, when is this portfolio to be rebalanced? Is the portfolio allowed to drift? Is rebalancing scheduled, strategic, or simply ad hoc? Is this portfolio utilizing active or passive investment management? You know how I feel about this one. Are there redundant holdings or overlap spread across different institutions or accounts? How is the investment taxed? An especially important consideration with taxable, non-registered accounts, both personal or corporate. Is there any use of alternative investments? Are there big gambles within the portfolio? The end result of step 1 of the fundamental retirement plan is a bespoke investment analysis that will help you flesh out potential traps or risks within your current asset allocation. We then layer this against our evidence-based investment philosophy that aligns with your financial goals and expectations. And this is built to stand the test of time, allowing you to relax knowing no matter what unprecedented event comes our way in the future, your ability to stay retired will never be in question. Now, in the next episode, we'll chat about step 2 of the process, income planning. As you follow us step by step over the next few weeks, I think it will become very apparent how all of these decisions we make impact other areas of your retirement plan. Okay, so that will do it for today. Just one action item for you. If you haven't done so already, be sure to check out our website, fundamentalwealth.ca, to learn more about our investment philosophy and the fundamental retirement plan. That'll do it for today. Hope you are enjoying these episodes. Be sure you add us on LinkedIn and Facebook. For all the links and resources we discussed, check out the show notes. If you're enjoying the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure that you're signed up for the weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.